Welcome to episode 9 of the Bautis Financial Daily Update, and today I want to talk a little bit about credit cards and the way the credit card companies are calculating the interest charges you're seeing on your cards. Now, if you're keeping a balance and you have a balance that you're working down, you're going to see an interest charge. If you pay the balance in full, then as you may know, there won't be any interest charges. So this is going to be the way that they're going to be calculating those interest charges for the month if you are holding a balance or carrying a balance from month to month. Now, first you're going to want to know your APR. Your APR is your annual percentage rate. You'll find it somewhere on your statement. Sometimes it's in the fine print, but you'll find it somewhere if you look hard enough. This number can be quite a range. I would say the average is about 18 to 20%, but it can be as high as 30. So today I think we'll just use 20% just to keep the numbers round. And then what they'll do is they'll take that APR and they'll convert it into a daily rate. So the way we're going to do that is we're going to take that 20%, or whatever your APR is, and then we're going to divide it by 365. Okay? And then that'll give us our daily rate, and that will computes to be 0.00055. And we're going to take this daily rate that we just converted the APR into, and we're going to multiply that by the average balance for the month. And the average balance will be computed by taking the balance each day, adding them all up, and dividing by the number of months. Now, most people are going to keep as you're spending money, it's going to change on a daily basis. So that's where it gets a little tricky. You can look on a statement and just basically take all the different balances you see as you're spending money or paying down the balance, and take all those numbers, add them together, and then divide by the number of months, and that's going to give you your average balance for the month. If you don't spend any more money and charge the card anymore throughout the month, and then your balance will pretty much be the same throughout the month, so that will, for the most part, be your average. But for today's example, let's say $5,000 is our average balance, and for the month, we'll then take this number, which was our daily percentage rate, and we'll multiply those together, and then that'll give us 2.75, and this is basically going to be a daily number. So we're going to want to then multiply that by the number of months, the number of days in the month, and that'll give us $82.50. So this will be your interest charge. Now, one of the things, the biggest takeaway here, I think, is the fact that they actually will calculate this on a daily basis on your average balance for the month. So anything you can do to keep your average lower, you're going to have a lower interest rate. So let's say if you're paying roughly $80 every month, and you can turn that into $65 by keeping your average lower, then obviously you should do that and try to, because obviously it's going to add up, especially if you have a large balance and you're paying it down over a long period of time. One of the ways that I've seen that can be key to do that and to help with that is a lot of times we have cash sitting in our checking account that's actually earmarked for paying down the balance, and we wait till the payment is due. So let's say, for instance, we have $1,000 in our bank account on the 3rd of the month, and we know we're going to use that money to pay down the credit card, but we wait the entire month until we pay it down. And what happens is if you pay it down later in the month versus paying it down early in the month, that's actually going to drag up your average. So if you had $1,000 and let's say your balance was $5,000 at the beginning of the month, if you paid that down in the beginning of the month as opposed to the end, your average would be $4,000 as opposed to $5,000. So as you're doing this, as you get the money, let's say if you get paid on a weekly basis, just pay what you can at that point. Or let's say you get paid on twice a month. This is going to help keep your average down, and it'll just reduce the interest rate. So if you know you're going to be using that money to pay it down, just pay it. Don't wait till the end of the month. But that's all I have for you today. If you have any questions on debt, just debt in general, credit cards, ways we can help you pay down some debt, or just questions about financial planning in general, please set up a consultation with us. I put the link to set that up in the show notes. If you have any thoughts, comments, please leave them in the comments section below. Thanks for joining me, and I will see you tomorrow.